When you're ready, sir.
Yeah, go ahead.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Scott Jackson. He's the Chief Investment Officer of Ravenwood Capital Management. He's got a microcap value strategy that's very interesting. We're going to talk about a specialty of his, which is Freedom of Information Act requests and what he's found when he's run those. We'll be talking to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
So you're 12-year veteran U.S. Army. What were you doing there?
Yeah, so I was on the Army National Guard for 12 years. Went in 2001. Before signed up before September 11th, and then went in basically like October to basic training, and man, it was just like flooded with people. And then did a tour left in like 2003 to go train, and then went to Iraq from like March 2004 to March 2005. Got back, and then just started going to school, and then that's where I kind of started digging into stocks and markets and stuff like that, and started really reading, and then got into Gonzaga, went back to Iraq for another year, and then started up, jumped on this guy was starting a small microcap value shop, and so then that was kind of where, he'd been doing it for, I don't know, 10, 15 years or something like that. And, that's where I figured out that you could make, 30%, 100%, 200% on stocks. Before that, it's like everybody was, kind of told you that you could expect an 8% return. So,
those little the microcaps rip around.
Oh man, they're so volatile. It's like the way I kind of describe it is that it's like being on a different solar system with a different gravity system, and it can change at any time, But yeah, when I was in Iraq, I was infantry, so we were running the first tour. We were running like full spectrum operations where, we would go from like 1 week we were like kicking indoors at 3 a.m. and looking for, weapons and bad guys and stuff. And then we would switch to patrols where we would be out in the neighborhoods doing like presence patrols and then we do med cap security. So for, our medics and stuff, we'd go set up and help the local communities, and we would pull security for that kind of stuff and hand out water. And then like the fourth week was typically like fixed site security. So we'd just be sitting on the towers, watching cars go by and stuff.
And when'd you get back?
The first tour was, left March 2004, and then got back, March 2005. And then, that tour was amazing, man. 'Cause it's like, Alibaba and the 40 Thieves, like palaces everywhere. What Saddam wasn't spending on weapons and gun, like palaces, or weapons and guns, you spend it on palaces. So, like the infrastructure was just nuts and everybody else was dirt poor. But there's some like amazing architecture over there for sure.
Did you see that stuff?
Oh yeah, no, we were like running around all these bombed out palaces, and there's like secret tunnels underneath and like dungeons, and like it's nuts, man. It was surreal, it was kind of a cool experience for a 20, I think I was 21 when I got over there, and then I think my birthday is March 5th, so got back just like shortly after I got over there when I was 22, but we were in Kuwait when I was still 21, and then when I got back I was 23. So for a 22-year-old, running around kicking indoors just in super good shape and working out every day and seeing all that kind of stuff was, just on a different level, and then like the combat aspect of it, I kind of figured out that I had like I just stay calmer than a lot of other people.
Yeah.
But when bullets start flying and stuff, but it's you definitely get to see like a different side of yourself and get tested in a different way, and then you get to see a different side of other people that you're with too, you know. But
so when did you start your MBA?
So I started up this company called Downriver Capital Management in 2010, and that was probably about like April, May 2010, and then I left there in 2015 to go back to school, and just wanted to start up my own shop and create my own culture and stuff like that. And then I finished the MBA in I think it was like December 2016. So started the MBA in May 2015 and then finished it in like December 2016. I tried to do it in a year, but then I ended up having to take like one class in the last semester. So.
And so the guy, when you were learning the microcap stuff, what was the style of that firm?
It was deep value. We were so if you pull up like the Russell data, like we had access to some of the Russell data and like where we landed, and it used Investment Alliance to kind of map all the institutional managers, you know, like Donald Smith and some of the other ones, and we were the lowest price to book debt to cap manager. Like if you plot that on an axis, you know, in a scatter plot type thing, like we were the lowest in the country. So you know, it was just straight. It was you know, and you're still coming out of the bottom, right? After all that stuff had gotten killed, and there was a lot of low price to book stuff that still had upside. And things would still get washed out into that area, but man, like after about 2000, like we had crushed it for probably, I don't know, two or 3 years, and like my portion of the portfolio, like we're probably banging down like 45% returns, and I was managing 20. I was thinking it was like 20% of the portfolio or something like that. And so we had landed, so when I joined this firm back in 2010, I didn't understand the space at all. And, you know, my business partner, I was like, hey, you know, where do we get the money from? Our AUM was basically zero. And so, you know, it's like high net worth, family office, or institutional. And then, you know, kind of walk through all of those, and then, you know, it was like, you know, how do we get the institutional money, you know? And then so started looking for RFPs, and then just cold calling the institutions, looking for like direct mandates, and then started talking to, you know, some of the fund of funds as well. And then we landed a direct mandate from MERS of Michigan in the amount of 25 million, which was pretty cool. And that was 2 years in. You know, it usually takes like you need typically like a 3-year track record, you know, 3 to 5 year track record. And then some of the institutions I've talked to can only be like 25% of your total AUM.
Right.
So we had landed that, and then it was kind of off to the races. But yeah, the price to book space, like that kind of slowed down when the economy started slowing down in like 14, and then everything kind of stagnated.
Yeah, it's been a rough run for the deep value guys since about 2015. So I see you launching about 2015. It's a tough time to get going. But what's the Ravenwood is the name of your firm. What's the focus of Ravenwood? What are you trying to find?
Yeah, so we've kind of evolved over time from you know, philosophy like you know, being like the lowest price to book debt to cap manager. We've always had like a huge focus on insider transactions in the open market and insider ownership. And that's kind of been driven by, there's a professor at the University of Michigan. I think I don't want to butcher his name, but I think it's Najat Sehan. And he wrote a book called, it's like Intelligence from Insider Trading or something like that. And basically had gone through, it was kind of the same type of format as Jim O'Shaughnessy's What Works on Wall Street. and with the core focus on insider transactions in the open market. And that the conclusion from that book was that, they tested, PE, and then, price to sales, and they focused on, they said if you combine, price to book with, the insider buys over 10,000 shares, which is kind of arbitrary, because you have different dollar amounts, then you would, and then you go down the cap spectrum into the microcap spectrum, you end up with like 40% annual returns. And so that's kind of been the cornerstone. I think I sent you a copy of the portfolio. If you look at the portfolio, all of our names have got just a ton of insider buying, no selling, and our stuff's pretty cheap. And like I was saying, like we've kind of evolved away from the price to book side, and it's more kind of your love for like enterprise value to EBITDA.
Yeah, I recognize a lot of the names as I was going through. They're all old friends of mine, a lot of them.
Mm-hmm. Yeah, they're so we do that, but then we also combine it with we like really try to drill down on the catalysts, and so we look at a lot of like alt data, and then
what's alt data?
Well, alternative data, so like Google Trends data, website traffic data. So we'll look at like what's going on at the top level. We'll look at like overall web traffic, like where the hotspots are. Like for example, like the way things have evolved in the pandemic, we didn't scrap the portfolio, but kind of sort of made small adjustments, and then kind of came to the conclusion that there were so many landmines out there and so much risk out there that we think that we couldn't see. So we didn't touch anything that didn't have insider buying after 3/15, when we were in the full blown pandemic. And then that kind of led us to, typically we use screens for idea generation, but we kind of backed into it and just used insider buys, and then looked at valuation, and then if valuation was good, then we moved on to the catalyst. And typically you could pair the catalyst up, you could figure out why the insiders were buying. So a lot of it was e-commerce driven, esports video game type stuff that was cheap, and it did we did really well.
So I see you've got this BAIT framework. Do you want to walk us through the BAIT framework?
Yeah. So BAIT. Michael Mobison's kind of gone over this, in a bunch of different podcasts, and I think he wrote a paper on it called "Who's on the Other Side." But essentially, the sources of alpha come from inefficiencies in the market, and they've been narrowed down to the BAIT framework: behavioral, informational, analytical, and technical. And so the behavioral aspect is you watch behavior. We watch behavior from corporate insiders. That's how we kind of utilize the framework. And then you have the behaviors from market participants, and typically we see it all the time where they kind of over extrapolate and pile in, things go up, they think things are good, they're gonna, and they treat it like trees are gonna grow to the moon, and they don't. So we kind of exploit those inefficiencies. And then informational. And then, so if you look at like the microcap space, it's pretty symmetrical. So if you look at like the number of analysts per company, on companies greater than 12 billion, you end up with like 18.54 analysts per company, and this is just from a screen on 12/31, 2019, for analyst coverage. And then, you get all the way down to, and then it steps down and kind of is symmetrically, kind of moves down towards you get to the less than $300 million range, and you end up with like 2.5 analysts per company. And then if you look at companies with no analyst coverage, there's like 1.2% of the companies with greater than $12 billion market cap have got, 1.2% analyst coverage, or with no analyst coverage is 1.2%. And then less than 300 million, you get, you have 70 71% of the companies have no analyst coverage. So it's kind of an informational inefficiency, less people digging. For the sell side banks, a lot of the market caps are too small, where they get that 3 cents a trade or 1 cent a trade or whatever it is now, half a cent a trade, and it doesn't make economical sense for them to initiate coverage on a lot of these microcap names. So there's just a lot less information floating around out there in the world, which you get divergence and value from price, because people just can't assign a value to it. They don't, because they just don't have the information. And then go ahead.
Yeah, on the technical front, what are you looking for technically?
Yeah, technically we've been kind of watching like ETF passive flow. So I think everybody's seen there's like a chart floating around out there where passive is supposed to outtake active here. I think in like 2021 or something like that. So we do look at, like one of the things that we did, coming out of the bottom, we looked at the ETF ownership, and it sells off. They get pushed down pretty hard, and then money comes back into them. So that's that wasn't like a cornerstone to it, but it's just a technical factor. And then you have other opportunities arise, caused by forced liquidations and delistings and things of that nature.
Yeah, so that's what creates the opportunity, and then you buy into it in the hope that they kind of they get caught back into those indexes maybe.
Mm-hmm. Yeah, exactly. Yeah, and they just come skyrocketing back. And then the analytical. So the analyticals, like you take information, then what do you do with it? How do you analyze information differently, and what's your edge on that front? And like I was saying, we look at alt data, we pair that. It's kind of like a cross sectional framework where we compare all these things, and they kind of confirm each other. So is there a catalyst? Like the insider buying says there's a catalyst, and then we try to one of the things that we really focus on is to kind of identify red flags, whether it's fraud, weakness in internal controls, changes in auditor statements, general language changes. We do a lot of the black line reports where it highlights changes in language throughout the Ks and Qs, 10K and 10Q.
How are you identifying the weakness in the internal controls? You're looking for that particularly in the auditor's report?
Yeah. Well, we're looking for the language, but then we also look for red flags like, net income higher than operating cash flow.
Right.
And then, stuff with high cash flow, but doesn't really, things that have high earnings and like low cash flow, stuff like Wirecard, that was just one that just went down. And then on the other side, we have some primary information too that we do to kind of reduce risk. We think it reduces risk, because microcaps, I think one of your biggest risks is fraud and just getting blindsided. So we do FOIA requests with various government agencies, but mostly we do it with the SEC. And the way it's set up, the SEC will tell you if there's an active investigation going on, and they can't like tell you that there's an active investigation going on, but they have to tell you whether whether documents are being withheld. And so that's a B7A exemption is what it's called. And so quarterly we do requests on all the companies in the portfolio just to make sure. And we've gotten ahead of a few of them, and they're routine. Like I think like every 3 years companies get reviewed by the Department of Corporate Finance for the SEC. But the investigations are different because they're done by the enforcement division. So when you get basically records being withheld, it says for investigative purposes and law enforcement purposes, which that doesn't have anything to do with the Division of Corporate Finance. That's all the enforcement division. So we look for stuff like that, and then we just don't take any risk on that. Typically where there's smoke, there's fire. We're not gonna, if something's cheap, it might be because of somebody's figured out something like that and they're short it. So Like I wonder, like there's a company right now that we did FOIA requests on the short side, and that's there was another requester that did a FOIA request for this company called Tactile Medical Systems, and there's been a couple short reports on it, and they basically came to the conclusion that the revenues are being overstated. So then, I see that, and then so I do one with the VA, and then it's just for 1 year. We have ones out for more years to increase the sample size of it. But I think that the revenues based on what the VA are telling me they're overstated by about 6 million for, I think it was 2018 or 19.
And how material is that to what they're earning?
I don't remember the split between. So they sell basically like one product, so it's super easy to track, and then most of the revenues are from CMS and for I think Center for Medicaid, and I forget exactly what it stands for, but that one's like very overstated. And then the one from the VA, I think they told me that they had 25 million in product sales, and the company reported 31 or something like that. So, it's quite a bit. But then there's also like short reports on kickbacks for the company and all kinds of stuff. So, I don't know what's going on there, but we find stuff like that, and then we've got a couple more FOIA requests at the SEC. Like I follow like a lot of the short sellers on Twitter, and when they start talking about names and fighting over, with the longs and stuff, like I'll just go run FOIA requests on stuff, and then send it to some of the people that are talking on Twitter, and just be like, hey, you guys got an active investigation on this thing. But
I think it's super interesting. I think it's one of the main reasons that I wanted to talk to you, because part of your strategy, you find these companies, and I didn't actually appreciate that you were doing this for your whole portfolio, but you submit Freedom of Information Act requests to see what's happening, and so you submit them to the SEC, and they have they're prevented from, they can't release the documents, but they can tell you if there's an active investigation going on. But you've been doing this for long enough that you know that every 3 years or so these companies get ordered or they get approached by the SEC. So that's not unusual. You're looking for something that's been handed across to enforcement. Is that what I'm understanding?
Right. And then as far as, so it's basically, the government's giving you somewhat non-public information, right? And the power of that information is kind of determines whether an investigation is disclosed or undisclosed. A lot of the times the investigations are undisclosed. And for the record, I don't have a long or short position in Tactile. It's just something that I've been kind of digging into.
So just walk us through the process. How do you submit a Freedom of Information Act request?
Yeah, so if you go to FOIA.gov in the U.S. here, you can basically, it pops up with a box for the agency you want to submit a FOIA request to, and a lot of them are on there. Some of them you have to go to the website for, like, Department of Homeland Security, I think, and then I believe, I'm not sure, there are a couple others that you have to submit just straight through email because they don't have electronic systems developed. But let's say you want to do it through, I think the SEC, it funnels it through to the SEC's website, and then you input, your information and then the company, and then you have a list of like what information you want. You can pull, complaints to the SEC. That one's always fun reading. Some of the complaints. It's a lot of the times when you pull up the complaints to whether it's the SEC or the FTC, it's the longs complaining about short attacks and short sellers. It's pretty entertaining sometimes.
Well, what have you ever found anything in there that's sort of that's helped you make a decision one way or the other?
Oh yeah, for sure. Yeah, definitely. We found a couple of active investigations on stuff that that we own that weren't disclosed. Like one of them was Gain Capital, and I think that I don't know. I think we got one through the SEC, but then we also got one through the CFTC, which was like the main governing body, from an FX standpoint. And then you go back and you search for like through the legal documents, and there's just a ton of complaints on stuff. But that thing, and it seems like that they're not good for the stock price. I don't know if people. It's hard to. There's no way to tell if other people are really figuring it out. You can see if through the FOIA logs, like what other people are requesting. So like when I look for like on the short side, like I'll search, like I download all of the SEC's FOIA logs, and then I'll just search the name of the company and see who all's done request on that specific company. And then I'll go and sometimes I'll request the requests that have been done on that company to see what some of these hedge funds and some of these firms that are contracted by hedge funds are looking for.
So they don't have to disclose that. The companies don't have to disclose that to the market.
I think it's kind of subjective. I think that it's it's not. Sometimes I think that they can make the case that it's not a material event, or obviously if there's like some big huge fraud, like they're gonna try not to disclose it, right? But a lot of the times they don't. So like one of the first things I do after I submit the FOIA request and ask for, and I have specific language that I use, ask for, I think it's like 6 types of records, like subpoenas, wells, notices, anything that speaks to the, conduct of, officers and directors involved with, that company and its subsidiaries. And then I'll also search, like if, like I'll look for, like I'll go on Edgar and I'll pull up all the correspondence. So if you type on like Edgar or Bloomberg, it's CORRESP is I think like the code for like 10K you'd punch into Edgar. And then you can start reading, like if there's any letters, you can see like when the last communication was. So, you can see what the Division of Corporate Finance was interested in, if they had any back and forth dialogue that they have to publish. I think they do have to publish any communications with the company, like any inquiries and responses and stuff like that.
Let's just talk a little bit about your strategy and how that creates the portfolio. So how do you think about position sizing, and do you let your winners run? Do you trim? What's the thought process around the portfolio?
Yeah. So and then real quick, go back. We started an LLC called FOIA Warriors LLC. We just started that a few months ago because this stuff is kind of gaining traction. But yeah, back to
well, just tell us about the FOIA Warriors.
Oh, we've been doing this since I think it was like early 2018, and then we do some outside business, like consulting type work as well. We do it on the local level, like with records. We do requests like with the city, and then we do requests with with the state, and then on the federal level as well. So it's like it works great for searching, for like 911 calls and stuff like that. I've actually done that, like digging super deep on some of the shorts, like pulled up 911 calls and
there are 911 calls on the shorts.
Yeah, well, on management teams, yeah. Well, not on the shorts, but like on the some of the short candidates, yeah. So on the managements, yeah. So it's
what kind of stuff? What are you finding?
Oh, just like neighbors, neighbors calling, because the dogs are barking, and then like DV type stuff, and then each request back you get from a record, you get breadcrumbs, right? So like you'll get traffic tickets, and then you'll know the car type, and then the VIN number. So then you run the VIN number, and then it pops up at someone's house at 1 a.m, that's not their house, and just stuff like that, and you just track it down. I mean, there's like no limit to like how deep you can go with that stuff. It gets crazy, man.
And these guys are managers of public companies.
Yeah, but yeah, and then you look for. I mean, and then if you're long something, I mean, you want to know if you see any like red flags or hear any weird stuff, like you would want to, you would probably want to start digging into it. And it doesn't take long. It only takes, I can put together like a FOIA request with the SEC probably in like 60 seconds. So. You can fire off a lot, and then it's just managing the information, and then back to the FOIA side, like when you typically will get a response, and then you have to appeal everything because sometimes they're wrong, sometimes they don't find everything, and that forces general counsel, I think, is typically the ones that kind of check the FOIA officers' work basically, and so they'll go back through and they'll check all the databases. And then they'll say, hey, we missed something. Like I found, it was kind of weird. I found one on GameStop that was from the end of last year, and it's like, oh, like we're withholding records, and then I had to submit like an appeal, and then it comes back, and then they give me the records, but it takes time to redact them and stuff like that, and then you get like I think I got a case closing report from that one. And then they recommend like no action, stuff like that. A lot of them will recommend no action. SEC's not in the business of put companies out of business and disrupting the financial market. So I think that they're pretty lenient for, first time offenders, but I'm sure if you get, you get multiple offenses, then they'll come through, or if it's, straight up blatant fraud on a huge level, they'll come through and they'll do their thing. But
let's talk about the portfolio a little bit. So, how do you think about sizing? How do you think about managing the portfolio?
Yeah, so it's kind of like almost like a ranking function, right? So you look at the valuation. I think it's there's a lot of white papers that number one contributor to returns is valuation, low valuation. So the lower the valuation, the higher that gets ranked, the higher position size. And then we look at insider buying, and then pair that with the catalyst, and if the catalyst appears very large and insider purchases are very large, those are typically the ones that end up the largest in the portfolio. And the cheaper they are, typically they get overweighted, right? And then as valuation kind of closes that gap between where it's at and what it's worth, you kind of lighten up the position as your upside kind of decreases. So that's how we kind of think about
how many positions in the portfolio and how big's the biggest position.
Oh yeah, so the biggest position right now is I think is around 10-11%, and we have about, I think, 23 names or something like that in the portfolio right now. And so it's probably more concentrated, but, if you look at, like modern portfolio theory stuff, like, the benefits of diversification, you don't get much more diversification from 20 names than you do from 200. And you don't get, if you had 8 names, like there's not much difference between 8 and 20. So, we don't have enough bandwidth to have 200 names in the portfolio, and don't think that really will create alpha. I think you create alpha by finding the right stuff and overweighting the stuff that's the cheapest with the highest catalyst, and then you collect your money and then move on to the next thing. And we have a lot of stuff that will it just kind of ebbs and flows. So as that gap between, what something's trading at and what it's worth kind of closes, we'll reduce the position, and then it'll kind of go back down. I think Greenblatt said, it's, I think he had, he said, stocks up 25% in a year. Most stocks are up 25% in a year, down 25% in a year. But it's like the intrinsic value of the business that didn't fluctuate by 50%, right? So, You get these moves, whether they're technical in nature or for whatever reason, and you just get price moves. But we always try to buy stuff that's cheap and yeah.
Do you want to talk about the portfolio? What's your favorite position in the portfolio right now?
I don't know if I should talk about the portfolio for regulatory reasons. I just don't, man. I don't want to be seen as like pumping, something that we own.
Well, let's talk about stuff that you've held in the past. What about Explore? Do you continue to hold that?
Oh no, that got acquired. So that was Explore Technology. They were a like ruggedized tablet and handheld device manufacturer, and they went through a turnaround in 2017, and then started executing. And there was a ton of insider buying on that one. And then they ended up going into July 2018. They were launching the handheld business, and I probably like a month before the company got bought out by Zebra Technologies, but probably a month before, I spent about 2 hours on a call with IR, and the company was already throwing off cash flow. And then they were just launching into the handheld business, and like the economics were pretty amazing, and there was a lot of operating leverage in there, and it was just right on the cusp of an inflection point to the upside. And then, obviously, I mean, I feel like I was right. The old make it or buy it thing. Zebra just came through and acquired him at $6 a share. And I think our cost basis was what was that, like $315 or something like that, or $350. Yeah, $318 was our average price on that one. And that was probably like the quickest buyout that we've ever had. We get a lot of get a lot of M&A in the portfolio in the microcap space. All the larger companies tend to swallow up the smaller ones. So that's, I had a slide on that one in there for for M&A on microcap. If you look at like all the public M&A deals by market cap, 55% of them happen at below the $300 million market cap level. And then if you look at the like the M&A deal premium, like the like 1 day move in a stock when they're acquired, it's on average 46%. And then just looking at that Explore Technologies, that one was that one got taken out like a 47% premium, so like right in line with the average.
Yeah, that's a nice bump. So I not to force you to talk about companies in the portfolio, but there's a few old friends of mine that I have to talk about with you in there. So let's talk about GameStop. Everybody knows about GameStop. What's the thesis there?
All right, yeah. Let me. I got to read the disclosures real quick then. Got to do it right, man. All right. Nothing I say today should be considered investment advice. Past performance does not guarantee future returns. Before making investment decisions, investors should consult a licensed professional and consider fees and expenses, their investment objectives and risk involved before they make any investment decisions.
I have been so advised.
But GameStop. That's a really interesting one, and it seems pretty controversial. I mean, it kind of appears to be a melting ice cube, right? And then I think we kind of talked about it a little bit on Twitter, but I mean Q1 and Q4 were just brutal, right? Going into the end of the console cycle. But I think that Michael Berry's right? Like, if you look back at cash flows and stuff, you can see that the console cycle does bring a lot of new revenues, and then the consoles come with pretty high margin in the hardware sales. But COVID has saved GameStop pretty well. There's you can't find a Nintendo Switch. Every time they get one, they're gone. and the COVID has just accelerated the move to esports and gaming in general. And then if you just think about it from like a market share standpoint for, entertainment in general, you can't go to the movies anymore. You can't, the bars have been basically closed for the most part. No one wants to go out. So you got all that, all those hobbies and things that used to eat up your time and money kind of shifting to, to gaming and things of that nature. We're going into the holiday season where they're going to release the next console for the Xbox and the PlayStation. At the same time, I think that it's, I think that the probability is pretty high that we're going to get another round of stimulus or unemployment, and it's probably going to continue to pay people more than what they were getting before. So I think there's, if you look at disposable income, like it's just kind of skyrocketed, with the checks and the unemployment. So I think that's going to really drive those console sales this cycle. So I think that people could be really surprised.
Yeah, so for folks who don't know, I'm sure that this is everybody, but Michael Burry, who's the Big Short guy played by Christian Bale in the movie, he's a phenomenal investor. Everybody knows this, I know, but just for the two people out there who've never heard of him, he's on Twitter now talking a little bit, and you can see his holdings publicly, and one of his biggest holdings is GameStop, which has been pretty controversial because it's very, very cheap. There's no question about that, but the issue is, as all of the sales of computer games go online, why would you need to shop through GameStop, right? So what keeps GameStop going if everything, you buy your console online and you just download the games?
Yeah, so right now, I mean, you can buy extra space, but right now I think the drives are only like 1 or 2 terabytes or something like that. And then if you look at like the new Call of Duty game that was released, like just to download the core game for that one, it's like, I think it's like 500 gigabytes, right? So it eats up a ton of the space on there. So, while you can add an external hard drive, like the stock consoles, they don't have enough storage to put unlimited amounts of games on there. You have to clear out some and delete them and then reinstall them. So, and then also, being a military dude, when we were in Iraq, we played a lot of games, and, just having like the disc to be able to give to someone else to play, is pretty huge. And it just removes that optionality, when you just buy, DLC games, right. But, and then also, from the kind of technical side, the float is 100% short right now, right? So, I mean, that's kind of like there's like a nuclear weapon buried in there somewhere.
Yeah, so you think if they get some unexpectedly good results, that nuclear weapon detonates and it goes up a lot.
Yeah, man, and I don't know. I mean, it's like, Wall Street bets, Robinhood, El Presidente, Dave Portnoy, man. I mean, one of these days could figure it out, and then I mean, it wouldn't take much to pile in there and set that thing off. So, while it may be a melting ice cube over a 5-year period, I think that like the chances are that it's got some serious upside, like in the short to intermediate term. I think you get paid by holding that thing.
Let's talk about another old favorite of mine, Fossil. What do they do?
Yeah, so they do they make watches, handbags, things of those nature, and then they do white brands as well. And then the stock's pretty cheap right now. It's got just a ton of buying, which is why we own it. And then you always, when you see the buying, you're like, well, okay, what's the catalyst, right? So you start digging through, and so they have a plan for like New World Fossil. They call it New World Fossil, and that's just, cutting expenses. And I think a lot of these companies in COVID, like they've cut a lot of expenses that they didn't think were discretionary, and they're kind of finding how far they can push the envelope to cutting expenses. And I think they're going to come out on the other side all right. And then, Fossil's, they're in the smartwatch market. They use the Android operating system for all their smartwatches. And then they're rolling out getting ready to roll out the 5G stuff, like LTE 5G stuff for all their smartwatches. So, I think that, we've done well in the name since we've owned it. But it's probably still got a ways to go. And then you go back, there's a lot of leverage in the model, right? I mean, it's just at 150. I think back in like $150. What's it at? Like 560 right now, or something like that. Go ahead.
No. It used to be net cash. I haven't looked at it for a little while, but when I was looking at it, it was more cash on the balance sheet than it was a pretty healthy balance sheet.
Mm-hmm. Yeah, no, they got a great balance sheet. Yeah. And that's one of the things we look at. We don't typically like to we don't mess around with debt too much. We like large cash positions. So
that's one of the nice things about the microcaps. Just for whatever reason, maybe this is the ones that I like to look at, but you can find them with still being run by the guy who started it, which I think Fossil was, or they're still involved. There's two brothers, I think, who started it. And then, net cash, still earning money, still doing pretty well, just not sexy in a world where there's Apple Watches and, other things like that.
Yeah, I mean, I think Apple's just eating the market with their stuff is just so far advanced to everybody else's. It's not even comparable, really. And just the way the ecosystem works.
So let's, last one, there's a couple more I want to talk to you about, but let's talk about Potbelly first. What's Potbelly do?
So Potbelly is they're just a sandwich shop, right? And I can't remember the mix between company owned and franchise stores, but there's a sandwich shop. They make sandwiches. It's not a great like sexy business. But the kind of the story there is that they're going to move more towards a franchise model, and then becomes more you cut OpEx and it becomes more capital light and more of a compound thing. So you get multiple expansion with it, basically, as the franchise owners pick up more stores. And
an old favorite of my wife's, they're pretty popular around here, the Del Tacos.
Yeah, that's a great one, man, and a good example of insider transactions. And that thing was just getting slaughtered, And when I picked up the phone and called IR when everything started kind of just getting whacked, and from February to March. Just trying to figure out like how much discretionary spending that they could cut, and it was fine. Just trying to figure out how much total liquidity that they had, and how much they could cut. But it's kind of got like a cult following, man. You're down there where you are, man. It's huge. Yeah, it's
my wife's in the cult.
Yeah, man. It's a great little company. We have one up here. It's in another town called Poles Falls. It's like I don't know, 30 minutes away or something like that. But it's like between where I live and the lake. So I'll always take my daughter like when we're going out to the lake and just check it out and check out the menu and prices and stuff like that, and just talk to the people working there to see what's going on. But that's got a huge runway for growth. It's pretty. If you look at the store count, it's all pretty much on the West Coast in California. Most of the locations are in California, and then it's the same thing as Potbelly. I think it's a better story than Potbelly, but there's a lot of company-owned stores that they're handing over to the franchisees, and then there's like no penetration for like half the United States. So, I like it. You like it. I think that it would probably pick up some traction across the rest of the states as well. It's like a I guess like a combination between Chipotle and Taco Bell.
Yeah. Maybe slightly healthier. That's right. Yeah. A bit healthier version than, it's like the
higher quality food. Yeah.
SoCal tacos. And last one, man, just because I've been in and out of this stock for a long time. Don't own it now, but IAG, I am gold.
Yeah, I am gold. We've been just cutting that company. That's a larger market cap. So, sometimes to own stuff like miners and get exposure to gold, it was still the same story. Like we pay our insider buying with, with catalysts and stuff. And that's kind of more of a, we're typically, bottom up fundamental investors, but that's more of a top down thing with all the printing, money supply expand. I think it's coming down a little bit, but, I think what are we up 18% year over year. And then we got a second round coming, another trillion on the, another 1 to 1.5, 2 trillion. Probably gonna have to do more the longer it goes on. The longer we don't get stimulus. I don't think that the economy's not strong enough to hold itself up right now. I don't think so right now.
Just to play on gold, just to leave it play on gold.
Yeah, exactly. And negative rates, right? I mean, there's just so much debt in the system, and then there's even more debt in the system now that everybody's gone on the revolvers in response to COVID. So it's just, I don't know how rates are going to rise without really messing things up. So, I think that the ceiling, what was it like last time rates were rising, was like, what was the 10-year, like, what was that, 3.2?
Something like that.
And then it's not 3.2 anymore. It's lower because there's so much more debt in the system. So I just don't think that rates are going to go very high. And then, you get cost increases, and I think that we have some pretty, with the 10 years at like negative 1% on a real basis right now. So, gold. We've got like a basket of miners, junior miners that have served us well. And then, on the market cap issue, it's hard to find a mining company that's a micro cap. In my opinion, it costs like $1 billion to create a mine. So it's hard to, it's kind of hard to, to find something that's somewhat stable in the, less than $300 million range.
You can find ones that have spent $1 billion on their mine and they're currently microcaps. I think I saw Intrepid Potash in your portfolio there.
Yeah. Yeah, we owned we owned that one back at my last firm, man. We owned that about like $18, and then same thing, like an OPEC type of thing. That's like the potash supply is mostly controlled by a cartel, and the Belarusian cartel. And then they came out and they said that that they're going to let prices dictate, or let the market dictate prices, and then it plummeted and just destroyed Intrepid Potash. And it went down. And if you look at the CEO has just been backing up the truck on those shares for years, man. So, it doesn't mean that it's going to turn out just because he's been, buying all that stuff. But there's a ton of assets there. They just recently, the last couple of years branched out into oil field services, providing, water. They're like smack dab right down there. I want to say, I don't know if it's the Permian or what, but they got a really good location to transport water to a lot of the drillers down there. And then they do the potash thing. And then they're also, I think they're the only domestic producer of potash in the United States. So if like things heat up and things get more protectionist, you kind of have that sort of thing built in. And then if we get into an inflationary environment, you got that working out as well. But it's not a huge weight by any means. But
yeah, that's great. Well, thanks so much for your time, Scott. If folks want to follow along with what you're doing, how do they do that? Yeah,
you can follow me on Twitter. I'm at price_to_value. And then, email is scott@ravenwood.capital, and then website's just ravenwood.capital, a little different top level domain. It's not a .com. Yeah.
Scott Jackson, Ravenwood Capital Management. Thank you very much.
Yeah. Thank you so much, Toby. Great talking.